1 2. Mic test 1 2. We are still trying out the streaming software. Mic test 1 2. Test 1 2. Text 1 2. Test 1 2. Mic test 1 2. Test 1 2. Test 1 2. Mic test 1 2. Test 1 2. Mic test 1 2. We are still trying out the streaming software. Mic test 1 2. Test 1 2. Text 1 2. Test 1 2. Mic test 1 2. Test 1 2. Test 1 2. Okay, yes, so I guess we are good to go. There is a bit of latency, but I think that will do for now. We will start. So, my name is Okoboy Charles Brian. I am a student, Bachelor of Medicine and Surgery at Soroti University. So, today I am also a trader. I'm going to be reviewing my trades, starting with the ones of I'll essentially start with all the trades that have been conducted throughout the month of January. So I will be going as far back. No, I think I'm going to start with this past week, which started with the 24th. And then later on, I will go on to the previous weeks as well. So this is more like my journal, and I'm going to essentially be reviewing everything that I went through this whole trading week. I have been trading using the ICT concepts, and I started at the beginning of this year to do the live trading. So this week, which was the 24th, was a Monday, and the thing that we started by delineating was the new week opening up. I just want to make sure I clearly show that here on this. So the week started on the 27th. So this 24th here was Friday. Then after that, so this is where we are going to start from. So now on the 24th this week, we had the new week opening up right here, right from the close. The close on Friday, 5 p.m. New York time, and then they open same time on Sunday. So this is the new week opening up. The new week opening up encapsulated from about 494 to 478. So that's a total of about it covered about 16 pips. So this is the new week opening up. Now on Monday, this is going to be the whole trading range for Monday. This was 26th, then 27th. So you'll just adjust here slightly with my calendar. So 27th was the open day. So this here is the trading range for the 27th, which is around here, and I'll be taking you through that. The market, after it opened on Sunday, I'll zoom in a bit. The markets opened right about here on Sunday. After it had opened on Sunday, it moved slightly higher back into the new week opening up, but it didn't cover. It covered more of just a quarter of it. Then thereafter, it started moving down. So we are accumulating sellers. So which means the market has been encouraging sellers. By this point, while we were opening on Monday, we had net sellers in here that were in with the stop losses where our liquidity is. The stop losses were more of here and then above this side. That's where we had most of our stop losses in this whole run down. Now on Monday, midnight, this is Greenwich GMT, we had relative equal lows forming. This was on Monday and Sunday, relative equal lows. So this here is where the liquidity lies of the people that that started buying here. This is where the liquidity lies. So at one point, we would want the market to come and run out this liquidity that lies under here. So as the price moves up, it's encouraging buyers, new buyers, but also it's seeking out liquidity which lies above here. So we took out the liquidity which was lying above here, which was created on Sunday, and this is still during the midnight to 1 a.m. This is this is Asian session. Then after that, after the market took, you notice that after the market took off this liquidity and some right above here, it consolidated a bit. Now this consolidation, if you study it very well, is to accumulate orders so that we can have price moving. So we have price making a low here, yeah, so which means we had some people buying from here, then some people selling from here. So the ones who bought here, their stop losses are below, so price comes and runs them out. So it swiftly runs them out and takes those out. Then after that, price runs out even the ones who had bought. So as here we still have new buyers whose stop loss is slightly beneath this place. So we have accumulated liquidity on either end. So we have stop losses. So it ran out that, then created a new one on this side. So liquidity lies. So as the price ran down here, we have sellers whose stop loss is above. Then now we have again buyers. So now you see that here we have created at that point we had created very good liquidity, where we had we had very good liquidity beneath this point where we had relative equal lows, which means we had people that had bought here and we had people that had bought here. They were confident about this being support for price to rally up. So true to word, price comes and runs out those stop losses first. Then after it runs those out, so we can put this here, then it runs out. You notice it pinches a bit deep into this. Then now after it does that, it now starts to move higher. Now as it moves higher, we have some people who bought from here as well with their stop losses. So we had some more here as well, who bought here, their stop losses beneath. Now the price, you notice, took out these buyers but left some. It took out the stop losses of the sellers here, but you notice it left some. So we still have those that are above. So as it did that, it came back and picked out. It is still in. We are still having liquidity being engineered, so it came and picked the stop losses down here. Then now it started to move up to pull up this liquidity. Remember, at the start of the day, we had the liquidity lying beneath here. So as the price takes out that liquidity there, it now breaks. Yeah, there is a break in market structure up here. So we have this low being broken. Notice there is no fair value gap up there. We probably do not have a breaker, so there was no clear opportunity. But after that, the price, after it has engineered liquidity, played around here, and it came close to the new week opening up. Or I would expect it to have wanted to test up there, but unfortunately it didn't. So as now price started to turn lower, this is still during the Asian session, it left liquidity above here. So as it runs down, you notice it's starting to seek the liquidity beneath here. So after that, price clearly takes out, and once it takes out that liquidity, it consolidates a bit. So Now there, once it has taken out the liquidity that we're seeking, so the next liquidity now that we have is the liquidity lying above here, and then maybe a lower level depending on how far it could want to go. So we have more liquidity now being engineered down here. So we have, as price was running down here, we have people who have been selling that price run, and majority of them, their stop losses above here. That's why we have that liquidity. Same thing, as price was running up, down, up here, it was running towards picking out this liquidity and the one that lay above the other side, which it didn't reach for. But as it ran above, it created buyers whose liquidity is above. So once it runs those, to take out the stop losses of those who bought, because that's the liquidity is what runs. How much money they're accumulating is what runs. So they seek to where the money is, and the money is where the stop loss is at. So it runs down here, takes this out. Then now here we start engineering liquidity once again. So we have this low here. So there are some people who buy there a reversal at the support level. So what price does, it comes and takes them out. So there is again liquidity above here, which would want price to take out. Now it comes, takes out the people who had bought the reversal again. Now at this point, we have liquidity which has built up on the buy side as well, those relative equal highs. So price comes down. We have still people that buy the reversal here. Price comes and takes them out still. So we have here, then price takes them out. Now you notice we still had on the downside, we have relative equal highs. So price would want to probably seek either of those. Toward it first started by seeking out the liquidity that lie. It hasn't yet picked it out, but I would hope for it to take out that liquidity. So it takes out that. Now you notice while price was running down here, we had some parts that had been left, and this is where price will refer back to. If it probably wants to take out now this liquidity that has formed, because there are some buyers here, it first went and sought the liquidity that was above here. As you can see, the price was just about the fair value gap. Now the next point we would watch out for, so it took out the liquidity that it has engineered here, then now it went to the fair value gap, which is a reference point. Then now the next sighting of liquidity that we would want is here, and then it going a bit lower. So but also to note, if we are to get a bigger picture here, is that this is where our price currently stands at. There is still liquidity that is lying above this place. So price would at one point would want to take out the liquidity that lies right above there. So but there is also that which price has left beneath. So price true to form moves down, then liquidity is engineered again. From here we have people that buy the reversal here, not a good break. Then so there is liquidity above there. So here there is liquidity that rests above this point that price would probably want to seek at one point, but then also there is this on the downside. So once price takes out the downside, would expect it to want to take up the upside as well and maybe seek the upper level. So it comes, tests down here, and then takes out the downside. That is art. So by the time we take out at the downside, our reference liquidity 1 is above this level, and then here down we have taken out this. So this is at 5. Price seems to, after this startling, it seems to move slightly higher, and then now we have a bit of engineering liquidity. The relative equal lows here that are taken out. Now this is now during the London session. Now you notice very sweetly here that once price was down here, it engineered liquidity, then took out this. After it did that, we have a break in market structure here, and once it did that, returned to the fair value gap. Once it did this, we would expect now price to at least take out this liquidity that was created very swiftly, and price does just about that. Yeah, so price just does just about that to take out the liquidity that had been created right there. And after that, you notice how swiftly it does that. It moves precisely. It moves precisely where, okay, this is after it bounced off that. It moves in London after there is engineering of liquidity here right before London. It now, the start of London price creates, moves right above there. Now after that we have our relative equal lows. Now these here that are in London are going to be again reference points for us for price to return to at one point or another. So we have this now being created. After price takes this out, it comes back, creates these relative equal lows, then now it rallies up. You notice that now at this point we would be cheering on at this point here. After price comes back to this level, we would now be cheering on for the price to now take out this high that was created during the Asian. So price does just about that, and it reaches even up to the higher end of that fair value of the new day opening up. So once it reaches there, it bounces off of that just a bit, then creates that, then jumps just about that, and continues moving up again. So you see how sweet this move was. Before we go into my apologies, I've had some distractions right here, but this is sweet. I'll just meet up here so that we don't have these distractions. If you give me a minute. So this is how we have been at so far about how this day traded. At least we saw that we had some activity here around the Asian. We created liquidity above, sold this liquidity that was below, created liquidity here, ran back into the fair value gap. So as price was running back, it created liquidity here, ran back, failed to touch here, stressed a bit, then took out that liquidity. Then now from here, it engineered liquidity such that at London, we were now having a turtle soup, ran up to take out the liquidity. Nearby, retraced a bit, broke, there was a break in market structure. Then now at this point, we now rally for price to take out one, the liquidity above here, but also would want it, with this liquidity is at the right at the verge of the fair value gap, would want of the new week opening up, would rally for price to run into that. It just did just about that, retraced a bit, reached for the higher end. Now once it reaches for the other end, the higher end, the liquidity at that point is either at the bottom here, or if it considers running further than that like it did here, which means would refer back to the previous week. Now that's on a higher time frame. But to move away from that, if we are now to consider, so we have seen that the London in this case was predominantly rising, and as it did that, if you can see, it was predominantly rising. By the time we reach the New York Open, at that point I want to just take you to the New York Open. By the time we reach the New York Open, which is just about here, by the time we reached the New York Open, price had moved up, and it was at a level of a fair value gap where it had been consolidating and accumulating orders. So at this level, just before we have the New York Open, we had we had we had stop losses. So you notice it's important to not be in the blind about where price is. So we had stop losses beneath here, then are above here, and then beneath here. So as price, so I think I'll analyze that so we can look at how the movement was. So we know it has been moving up. So we have our above there are stop losses. So there are some people who traded the reversal, their stop losses lie above. Then there are some people who wanted to trade the continuation, their stop losses were above there. So as price ran, we have accumulated the orders of those who wanted the reversal and those who wanted the continuation. So again, there are some who sold the reversal there. As price moved up, their stop losses were above. So right as price moved up again, we had some. So you notice that here price had created relative equal lows here, and then relative equal highs above. Price would want to destroy each of these and then accumulate liquidity before having to run to another price point. So what price, like we can see here, relative equal highs, by the time price was here, it created another, then pushed up to take out those. Once it took out those, we now had this taken out, this high taken out. So now price now moved, the next target would be beneath here. So price moved and then took out just about of this, but it did fail to take out this other low here. So we have liquidity currently. By the time we're going into London, there's liquidity lying beneath of that. So new relative equal highs were created above here. Now if we are to analyze the London session independently, is that we had liquidity above here because we had sellers coming in, but now there's new liquidity created above here. So we have this, then price moved high, now lower. There's a level that we're looking at. So price comes again and tests just about that. So by the time it takes this out, so there are some way testing as price. So generally we had sellers at the beginning of the New York Open now, which means we have their stop losses above there. We had those try to attempt the buy here, the reversal, but that's not a wise one. So price took them out again. Then now we had the ones who had sold stop losses above. Then again we had these stop losses above, took those out. So we have the stop losses above here. Now here at this point, we now had price showing us a very good swing point where we had relative equal lows and would want to see price push through that at one point. So price moves away from that, moves above, creates relative, takes out the buy side. Now we would want a break in market structure that is sweet, but we didn't have one because we would be targeting here. So this is the point that we have had so far created. So price rallies above instead. So which means for this day we probably wouldn't have had any decent trade because the New York Open, which tends to usually have the reversal or retracement, here we had a continuation, rallied above, took out this, continued above. This was an inversion fair value gap, continued. So probably the idea would be to trade this break in market structure here. But as you can see, yes, as you can see, it wasn't as clear because the break in market structure probably came here, and the only fair value gap we had was in here. So the only fair value gap we had was in here. Price retraced back into it. Now this trade was probably a valid one, considering how I would have wanted. This first one was a mistake. I think rush trading, but this second one, probably one could argue that this was too far to consider as a fair value gap because the stop loss would have to be a bit too high. So it would probably be just over trade. But I think it was valid, but also given that it had just taken out liquidity here, would not be a wise trade to take out, because in that case which means the seller here was probably considering more of the longer term, but probably not looking so much about this price level here. So this one here could probably be something to consider, that whenever there's a price level, especially that would act as liquidity for the stop losses being taken out, it's important to reconsider that. Otherwise, this price leg here would have been a nice one to trade down here. So price comes, takes out this liquidity instead. Then after it does that, it there is a break to the upside, no fair value gap. It continues back now into the upper fair value gap. Doesn't consider this one as much. Then so from this point forward, I think there is another break that came in here, but I think yes, there is another break, and in this case I think I was favoring the downside to take off. My eyes were set on the low which had been created during the New York Open. I ignored the levels, so there is relative equal highs that have been formed up there. Price could push through them, so there is what you would call a break here with this. There was a break somewhere here. You would consider, one would argue that this was a fair value gap, but probably not a very good one, given that this level was not broken. Yes, it was broken sufficiently, then price traded right back into it, but probably not a good one. As you can see, it went back. There was this other fair value gap to the top, right about here, and then now that's where price trades off of, and then it continues to move down until the other mark, where it now moves down again. So we probably can zoom out of here and see how price played around these points, that it finally broke and took out this liquidity, but probably the timing is what was the challenge for this. Yeah, you can see that liquidity, yes, had been engineered down here, but there was also some liquidity above here. So once price came, it moved higher, moved away. One would argue that there would be a good break here, so look for a fair value gap, but this fair value gap is way too down. It's actually the price of buy side liquidity, so it's probably not something worthy considering as much. Price went back up, and then yes, it broke here, so this would be the uppermost, would be the best fair value gap to consider. Price trades back into that, moves, then gives another test of that, takes out that liquidity, gives another test of that, takes out that liquidity, moves probably not as fast as it should have, then moves, continues. Now by that point is now where it took out, because the goal would have been to take out the liquidity, right? The price swing would probably be from there up to about there, which is about 13 pips for a risk of about 6 pips. So this was a good 2 to 1. So it's important to consider the ratios here as well. So that's how price moved that time. Now the other one probably would be that by the time we're starting the 3 o'clock, which is the 9 to 10, yes, no, 8 to 9, the price has been moving down. It has just taken out relative equal lows, so which means we would expect price to reverse or to continue pressing through that. So it gives us equal highs, then equal lows, pushes off of that. So The other option would be that it would want to engineer liquidity here as well, and it does just about that. So this we see for this day that this was Monday, and we see that the retracement came in a bit much later. That yes, we had been bullish, we would want a retracement or a reversal, but that came in. It did come in, but it didn't come in exactly at the 7 to 8 or 8 to 8:30. It came in at about a bit later, I think 9 to 9:30. Then that's when our price moved down, engineered. Then it preferred to take down. There was liquidity right beneath here, so it ran for that liquidity point. So by the time we are now going into this day, we now have new levels. We have levels that have been run off. We have levels that have been created, and that's how we'll start. So that was the trading for the Monday. Key takeaways is that the timing for the analysis was good. The timing for the entries was about poor. That can be worked on, of course. At least it's a good start that the trades were timed. At least the idea was there. It's just the timing that probably wasn't as good, because as you see, this was a sell, a loss there. This was a sell, a loss there, and then price actually moved down after that. The stop loss was a bit too tight, which shouldn't be, so it's better to look for nicer trades with greater risk to reward ratio. We'll continue off of that with the Tuesday's trading. Thank you. So I'm going to end this stream for now.